Hello, and thanks for joining. My name is Luke Yango, and I'm happy you were all able to join because today we have a very interesting webinar because there are a lot of misconceptions surrounding the topic of life insurance. And I'm excited today to help to clarify many of those misconceptions. But before getting into the topic, as always, let me spend a little bit of time explaining to you all exactly what is it that my firm does and who exactly we are. For those that are not clients on the line, of course. And as always, a quick note from compliance. If we're talking about any tax related items, be certain to review them with your CPA before executing. But back to us, we're a boutique wealth management and financial planning firm here in Irvine, California. However, we have clients across the entire nation. And what we do with our clients, many of which are on the line, is we work with them on their holistic financial planning and investment management needs. We find that our industry is just too focused on just the investment side of planning. So we make it a priority to take both a comprehensive and a holistic approach to planning and to continuously educate, which is one of the reasons that we host these webinars. Now, our process involves building a well designed financial plan, organizing our clients' investments in coordination with that plan, and then ensuring that any outside planning items have been handled, which may involve our collaboration with other professionals. And here's a quick overview of our team. We have 7 advisors. We have a retirement plan specialist. We have an investment specialist, and then 3 administrative assistants. But enough about us. Let's get into today's topic. And shown here are the areas of planning we typically discuss with people. But for today's conversation, we will first and foremost discuss how to manage risk through the use of life insurance. Risk being one of the pillars to the planning pyramid. Additionally, insurance also can play a role in helping to mitigate tax. So there are a lot of tax strategies where life insurance could be utilized, but it's extremely important to understand, those strategies do have shortfalls to them, and it's important to be aware of that. And we're going to be discussing that today as well. And lastly, life insurance can be used for legacy planning, whether you wish to leave maybe your family a guaranteed inheritance or potentially leave your family liquid cash to help them pay estate taxes. Life insurance can help to plan for that. What I want everyone to be aware of is that insurance is just a tool. There are a lot of versions of life insurance, and there are different strategies that require different types of insurance. So, understanding these concepts, these strategies, and the available policies is always the first step in ensuring that you have your risk management and insurance plan in place. So, for today's conversation, it won't be excessively long. However, we will review a good bit of information, and I'm going to be opening it up to questions at the end. So please hold off on any questions until then. But first, I'll briefly explain some of the misconceptions of life insurance. Then I'll get into the various types of life insurance options. And I have to say that there are a good bit to choose from. And this is where it can get a little complicated, but we'll discuss it all. And third, we'll discuss the taxation of life insurance and how it can potentially be used as a vehicle for tax deferral. And then lastly, we'll discuss how to rethink life insurance. Life insurance isn't good, it isn't bad, it's just a way to solve a potential problem, really to fill a need. And if you have a need for it, then there are certain steps that you can take to ensure that you're not overpaying, but also ensuring that are putting your money towards the right type of product or the right type of investment. So let's begin with just the misconceptions of insurance. And the first misconception I hear is that life insurance is all the same. And simply put, it's not. While they stem from the same concept of I die, the life insurance company pays my family a death benefit, there are a lot of variations to that type of insurance. And that is where specific strategies come into play. The second misconception I hear from people is that, life insurance through work, the coverage you have through work is sufficient. Now, that could actually be accurate. However, it's not always the case. We'll get into this in a little bit, but coverage through work is unique. And the policy you may have could potentially just go away, and that could potentially leave your family in a situation where they're unprotected in the event that you were to pass away. So sometimes it's not enough coverage, but sometimes coverage through work is sufficient. So just being aware of the specifics to it is important. We're going to review those specifics. The third misconception is that some people think permanent life insurance coverage is only for the wealthy. And if you don't know what permanent coverage is, do not worry, we'll discuss it today as well. Whether you are rich does not necessarily determine what type of policy you need. Your objectives and your goals will help you uncover that. The fourth misconception, misconception, excuse me, is wrong because the cost is almost always 100% based off the type of policy you purchase and the coverage you apply for. So ultimately, you're paying for the policy, or the amount that you're paying for the policy is actually designed by you. You really control the costs. The fifth misconception I hear is that term insurance is a waste of money. And this is just wrong because term insurance covers a need. And we'll be discussing the various needs that call for term insurance later on in today's conversation. And lastly, I do hear from people that they don't need insurance if they don't have kids. And in many cases, that is accurate. However, there are specific situations where you may want to consider it, and we'll get into those today as well. So, enough about the misconceptions. Let's get into the meat of today's conversation by first reviewing the various types of life insurance coverage. And there are two main types of life insurance options: temporary insurance coverage, or term for short, and permanent insurance coverage. And they are exactly what they sound like. Temporary term coverage will only cover you for a set period of time, while permanent coverage is meant to last a lifetime. And some would pose the question, why would you ever want temporary when you could have permanent? Well, term and temporary types of insurance are usually a lot cheaper. And generally speaking, they solve different needs. But with temporary insurance, you first have group coverage. Now, typically, this is going to be through your employer. And how this type of coverage works is you usually get a benefit automatically, maybe 1 to 2 times your salary from your employer. And you may be able to increase your coverage up to a certain amount of time. But there are two subsets of group coverage: portable and non portable. Portable means that you have the ability to keep the coverage if you were to leave the company, and uh, non portable means that the benefit would go away when you were to leave the company. This is the main issue with group coverage. Most group policies are not portable. So in the event that you were laid off or decided to leave a company, your insurance coverage, the coverage to protect your family, may go away, and at that time you would no longer have insurance protection. And that then leads me to the second type of temporary coverage, which is private term insurance. And with private term coverage, you would apply it directly through an insurance company and have a locked in amount of coverage for a very specific amount of time, no matter what happens. You could lose your job, get sick, whatever. So long as you're paying the premiums, you have coverage. And if you were to pass away during the life of that policy, the insurance company would pay your heirs the benefit that you applied for. And with private coverage, you typically receive what's called a level benefit, generally speaking. And that means if you were to apply for, let's say, $1 million of coverage for 30 years, your death benefit would be $1 million whether you passed away the first day of the policy or the last day of the policy. And your premium payments, generally speaking, would be level throughout the life of the policy as well. So it could cost you a couple $100 a year, and that's going to cost you the same when you're older as when you were young. But all in all, temporary life insurance is very straightforward, and typically the strategies involved with temporary policies are strategies which require short term coverage. For example, protecting your income for your family during your working years to ensure that if you were to pass away, your children could afford a good college education, your spouse could still pay down the home, and ultimately they're financially sound. Permanent policies are a little different, though, and there are a lot of options with permanent. Shown here are the 6 main permanent insurance offerings. Now, these types of policies are all different in how they're structured. However, they're all very similar at their core. First off, they're typically designed to last your entire lifetime, meaning at some point the policy will pay out a death benefit when you pass away. Secondly, the policies have both an insurance bucket and a cash value bucket within the policy. The insurance bucket is the death benefit that will be paid out to your heirs when you pass away. And the cash value bucket is the benefit that you potentially can utilize when you're alive or your heirs receive at your death, along with the death benefit, of course. And essentially, when you pay your premiums, a portion of the premium goes to the cost of insurance, just like with term insurance. But then the remainder of that premium goes to what's called the cash value bucket. And then the cash value bucket usually grows throughout the years as most of these policies involve having the money invested in some way, shape, or form. The big difference between these types of permanent policies is usually how you handle the investment component of the policy or the cash value. But in summary, permanent policies are meant to last a lifetime. They can be used as a type of investment as well. Now, this may not make complete sense, but we're going to get into this in a little more detail in a couple of slides. So if you have questions, I'm sure they're going to be answered shortly. And before getting into the complexity of permanent policies, I want to first spend some time reviewing the pros and the cons of temporary insurance, as term, quite frankly, is a little easier to understand. So let's just start there. Now, the benefits to group term coverage are typically great. Many times, the life insurance benefit is free through work or just very, very cheap. Additionally, like I mentioned in the last slide, you may be able to increase coverage as well, which may be very inexpensive to do through your employer. And lastly, with group coverage, you rarely have to go through what's called underwriting. Now, there are a few serious cons to group coverage. First, you usually have limited, or I'm sorry, you're usually limited to the amount of coverage that you're allowed to apply for. Second, as I mentioned, the policy may not be portable. So if you have a specific need you're trying to cover, that need may lose coverage if you were to lose your job or if you decided to quit. And third, group coverage doesn't have a specified term. Usually, you're just going to be insured as long as you're an employee at that company, and that's group. But with private term, or what private term insurance does, is it really solves the issues of group insurance. With private insurance, you have a locked in length of time for your policy, so it doesn't just go away if you were to lose your job. And your premiums are also level, meaning that every year you pay, you end up paying basically the same amount, unless you have a very unique term-based policy. And additionally, there are typically no limits to the amount of insurance that you can apply for. So you can apply for a couple 100,000, a couple million. It's really dependent on your needs. Now, obviously, the more insurance you have, the more expensive it will be. However, at least you have the option to set it at what you would like for you and your family. There are cons to private insurance, though, and the first is it's generally more expensive than group coverage, and that's just a general rule of thumb. There, every insurance company is different. But additionally, if your benefits expire, then you receive nothing back from the insurance company. And lastly, private insurance will require underwriting, which means that you typically need to complete some sort of interview. You might have to potentially take labs. There's going to be a health screening. It may require that doctor records be pulled on your behalf by the insurance company. But in a nutshell, that's temporary coverage. And we'll get into the strategies associated with it shortly. But first, let's just review permanent coverage in more detail as it is a little more complex. And as I mentioned, permanent insurance refers to those policies that provide coverage for your entire life, so long as the premiums are paid correctly. And they have two components to them: a death benefit and cash value. And in simplest terms that I can put it, shown here is the process to invest in a permanent policy. First, you pay your premiums, and the money is then separated down two different avenues. First, the cost of insurance. This is the money that the insurance company is going to keep because you are paying for the yearly cost to cover whatever death benefit that you may have applied for. The rest of the premium payment is then sent to the investment side of the policy, and then it begins accruing what is called cash value, which is typically invested on your behalf, and many times you can choose the investments. And as your cash value grows, it can then be used for three things. First, the cash value can be used to pay the cost of insurance so that your out of pocket premiums aren't as high. Secondly, you can distribute the cash value once it has accrued to a certain point. Now, we'll talk about the taxation of these distributions shortly, but in general, there are a lot of tax benefits to these types of distributions because your money grows tax deferred, and sometimes the distributions are tax free. Lastly, you can actually borrow from the policy in the form of what's called a policy loan. Now, you may be asking yourself, why would I want to borrow money from a policy that I have full access to? And the simple answer is to avoid taxes. But we'll review this in much greater detail on the next few slides. And lastly, these policies eventually end upon the death of the insured. And when that happens, their heirs receive a benefit, which includes both the death benefit applied for and the cash value that is currently in the policy. So as you can see, there are a lot of moving parts to permanent policies, and dependent on your reason for insurance, that will ultimately determine if you need a permanent policy, if you need a term policy, and really the specifics to the policy applied for. But there are more details to permanent policies, so let's just review those now. Excuse me. And the cash value is one of the main reasons people invest into permanent policies. So it's very important to know which policies have what type of growth associated to their cash value buckets. And with whole life and with universal life, you usually have a fixed rate of growth of cash or of your cash value. And generally speaking, these two types of policies are not the most efficient to grow your cash value over a very, very long period of time and are typically used if you just want to have a guaranteed death benefit for your heirs when you pass away. Variable policies have cash value that is invested very similar to how you would invest in mutual funds. Now, this type of performance is not going to be guaranteed, and you can usually be about as risky or risk adverse as you'd like. The only nuance with this is that you don't necessarily get to choose the mutual funds available to you. So the insurance company will provide you certain options within the policy, similar to like a 401k, for example. And then the insured would then be allowed to choose how they want to allocate future cash value. And keep in mind, they're not called mutual funds, they're called sub accounts in a life insurance policy. And lastly, indexed policies invest the cash value based on varied indices, whether that be the S&P 500, the aggregate bond index, or something else potentially. But all in all, your cash value's growth will ultimately be determined by three things. One, the type of policy you invest in. Two, the individual investment options and the allocation that you elect. And then three, obviously, how the general market performs. And that leads me to the topic now of tax deferral. Because when cash value in your policy grows, you then have the ability to implement some tax saving strategies. And to summarize what I talked about earlier, the cash value in a permanent policy grows tax free, similar to how the growth of a 401k or an IRA works. As long as the money stays within the 401k, IRA, or insurance policy, you typically defer taxes. Now, with a 401k and an IRA, you pay income tax when you ultimately distribute the money from the policy, or I'm sorry, the account. But what I'm about to get or talk about is when you take money out of an insurance policy. What happens then? Well, as I mentioned 2 slides ago, you can access that cash value through either a distribution or through a loan. And that is what I want to talk about now because that is where the strategies lie. Let's first talk about distributions. Essentially, what this is a permanent reduction of your cash value. The good thing about these distributions are that it's a non-taxable event so long as you don't distribute more than your cost basis. Ultimately, the benefit here is you have just delayed taxes on all the growth of your cash value, and then you don't pay any taxes on the distributions, but that is of just the cost basis. The second way a policy can be used for tax deferral is once you've distributed all of your cost basis, you potentially could take a policy loan. And this is the second step to distributing from a policy. Because when you take a policy loan, you are essentially borrowing, you're not distributing. So you could be borrowing once you get to the point that you have a distribution which is counted as the growth of the account, which would normally be taxable. But because you're borrowing, you're not having to pay that tax. It's a no tax loan. The nuance here, though, is that interest does accrue while you have an outstanding loan, and it does count against the remaining cash value and the death benefit in the policy. So if you never pay back the loan, you'll receive a permanent reduction of your death benefit as well as a second reduction due to the interest accrued. If you pay the policy loan back, though, the interest is actually paid back to you, and then it wouldn't count, and then it would also count towards your cash value. That's very similar to if you have a 401k loan, if you're familiar with those. The benefit here with these loans is that even after distributing your cost basis of the policy, you still have another tax-free avenue to receive cash in your pocket if needed. And lastly, your heirs' death benefit, including the cash value, is typically a non-taxable event, meaning your heirs wouldn't have to pay income tax on the death benefit of the insurance policy, as well as the cash value, which is added to the death benefit. But that about sums up the tax deferral strategies of permanent policies. And now I want to review the other strategies one may want to consider when thinking about life insurance. And coming full circle, I want to say again that all life insurance policies are different. Everyone's need for insurance is different. And what that means is you first need to understand the specific need that you are trying to solve, and then you can essentially back into the type of policy that fits your needs. So, what I'm going to do is talk about the 5 most common reasons people receive life insurance coverage, and then discuss a quick suggestion on what I would recommend. First off, income protection is usually the largest need of people buying insurance. And simply put, term insurance, in my eyes, is typically the most efficient way to protect your income because ultimately your income goes away when you retire. Let's say you have a spouse, kids, and a mortgage, and your income supports your family's lifestyle. What would happen if you died? Well, your family may be in a severe financial situation, so life insurance may help to cover that risk. But what's important to know though is this is a temporary risk. Eventually, your kids are out of the house, your mortgage is paid off, and you'll have enough money saved for retirement. And once that's the case, is insurance really needed anymore? So, why pay more for an expensive permanent policy when you just have a short term need? The second strategy I want to discuss is legacy planning. Many times people want to leave a legacy no matter what for their children. Well, there's a very simple way to do that, and that involves permanent based life insurance policies. It's a way to ensure that you're leaving a specified amount of money to your heirs upon death. Ultimately, it just allows you to plan ahead and then to have the assurance that your money is there at death for those that you wish it to go to. Another type of need some people have is related to their business and if something were to happen to them. For example, two partners in a firm each own 50% of the firm may want to protect their share of the business for their family. But if they were to die, then they may not want to leave the burden of running the business to their family. So, in a situation like this, a buy sell agreement makes a lot of sense, which is essentially an insurance policy that would pay your family the value of your share of the business in the event that you passed away. And the business at that point would then go to the surviving partner. These types of policies are purchased by all the key owners of the business to ensure that their families are protected in the event of one of their deaths and also ensures that the business continues to run smoothly. Now, a term or a permanent policy may make sense for a case like this. However, it does depend on your individualized situation, so just be sure to talk to someone who understands this type of planning. College planning is another area that insurance plays into. Many people want to ensure that their children have the money needed to pay for school if something were to happen to them. And just like income protection strategy or the income protection strategy calls for term insurance, college planning also does. Now, tax deferral strategies are by far the most misunderstood planning strategy that involves insurance. So, what I want to do now is give my thoughts here in great detail. And I'm going to say this, and this may contradict what you've heard from other people that work in the realm of insurance. But insurance is not, and I repeat, is not the most or the best way to defer tax. It is a way to defer taxes. However, there are plenty of other methods which, in my opinion, you may want to execute first prior to using insurance to defer tax. So when you get your paycheck, you have an influx of money. And first and foremost, generally, your 401k or your self employed retirement plan, or just any retirement plan that you have, is the most efficient way to put away money. Because as you know, you not only receive a tax deduction on the contributions, but you also receive tax deferred growth on those investments. So if you can, try to max out that plan. It's a very strategic tax deferral investment strategy for you. In 2023, you can max out a 401k plan at 22,500, and if you're over 50, you can make a catch-up contribution and put a total of $30,000 into the plan. Now, once that plan is maxed out, you potentially have the option to put $6,000 to $7,000. It's $65,000 to $75,000 or $7,500 in an IRA or a Roth IRA. So once again, once you max out a plan, you might be able to put 6,500 to 7,500 in an IRA or a Roth, depending on your income level. Now, most people, this is generally speaking here, do not have the option to both max out their 401k plan and their IRA, because if they have the ability to max out a 401k, their income is probably pretty high, which means that they can't make a deductible IRA contribution or they can't make a Roth IRA contribution. So in that case, the next option for them would be potentially to make what's called a non-deductible IRA contribution. And essentially what this is putting money into an IRA and not receiving the tax deduction. But you do still receive tax deferred growth on all the investments. So if you've maxed out your retirement plans and you have more money to invest and you want to defer taxes on those investments, then a non-deductible IRA may make a lot of sense for you. And of course, there are a lot of variables to consider. However, in many ways, this may make sense. And if you are able to potentially, you could do what's called a backdoor Roth IRA conversion, which would also be another great strategy to consider. It is a bit complex though. However, if this applies to you, it could be a very, very strategic planning option dependent on your situation. So if you don't know what that is, be sure to do a little bit of research because it's nuanced, but it is a very creative strategy to execute on. But once all of those strategies are executed on and you're still looking for tax deferral, insurance may be a very good planning option for you. And why it may be a good planning option is because of the tax deferred growth of the investments within the permanent policy. By putting your money in a policy rather than just some taxable investment account, you could defer taxes and potentially utilize that money tax free down the road. The nuance with this strategy, though, is that you still have to pay the cost of insurance, which is the yearly cost to own the policy and to have a death benefit. So I usually tell people if they've executed on the prior strategies and they have a need for insurance, for example, they have children or a spouse, they want to protect their income. Well, then it may be a very strategic planning option. The issue here, though, is many times people are put into these policies for tax deferral, but they haven't properly checked off all their prior tax planning strategies. For example, maxing out their 401k. But if you've maxed out your 401k, you've executed maybe a non-deductible IRA contribution, then a permanent policy may make a lot of sense for you, especially if you have the need for insurance protection. And then, of course, lastly, once you've done all that, a non-retirement brokerage account is a good route to go and put money away for growth. It's just not going to be tax deferred. But once again, I want to reiterate this. Everyone's situation is different. So rather than just going by certain rules of thumb that I'm talking about, it's best to speak to someone who understands the holistic financial planning space to be certain you're doing what is right for your individualized situation. So with that being said, it is always good to rethink your life insurance needs. Whether you have insurance or you don't, there are a lot of triggering moments in one's life that should make you rethink and review your policies or just consider executing on a policy. If you've gotten married, if you've purchased a home, if you had a new child, if you've gone through a divorce, if you changed employers, if you started a business, or your business just has grown significantly, if you've received a promotion, if you've maxed out your retirement accounts for the year, if you retired recently, or just any major life event, these are all triggering events to not only rethink your life insurance planning, but also to rethink your financial plan. And my job is to help educate and to help those navigate their financial planning, which may involve life insurance. So if anything in today's webinar resonated with you and you want to have a conversation, please don't hesitate to reach out. I am here to help. And for those on the line that are clients, please reach out if you ever have questions. Our job is to be there for you from a financial perspective, as well as from a financial planning perspective. So if you ever want to talk about strategies, talk about your planning, and maybe how life insurance may play into it, reach out. We're always available. And for those that are clients, we are here if you have questions. And if a relationship with us is something that you may be looking for, we can always talk about what that would look like. But I am going to open it up to questions now. But before I do so, I do need to end the recording that we are recording right now. So hold on one second for those that are on the line, and we'll get to questions shortly.